Hello, everyone. Welcome to the FTX podcast. We have my friend Trabucco back for round 2 on the FTX podcast. Welcome, man.
What's up?
Good to have you on. I mean, I know everyone's been talking a little bit about what's next for you, so we wanted to bring you on. And actually, more so than what's next, kind of go into the past. I know that you have been trading for quite some time now. I mean, you had been at SIG before, and then you're taking that time in between, and then Alameda. So I want to kind of go back and maybe hear some war stories over the years. I'd be curious to start maybe with like what you were doing at Susquehanna, and if there was anything that really stood out to you there that marked you from that time, or if all the excitement was in crypto.
Yeah, so I wouldn't say that SIG was the most exciting place. That's part of why I ended up leaving. It's a great place to learn the fundamentals of trading. I did an internship there where we sort of talked a lot about like fundamentals about how to think quantitatively, like make decisions under uncertainty. I learned a ton there, so I don't want to discount that. But that like crypto as an asset class is just so much more exciting than really any traditional finance products. And so yeah, like I learned a ton about like how to shift my mindset while I was there, which I would later get a lot better at too. But yeah, like the more interesting like trading stories, I'd say, certainly happened after I left SIG.
And do you think for people that want to become traders in crypto, they should have a sojourn over at a large firm first and then move over?
Like it's definitely super valuable. An advantage that these like a firm like SIG has is that they're quite large. They've been around forever, and they have a very established education program. They run like a fairly large internship program for like undergrads, and they like teach their new hires after graduating like quite a bit. Which at Alameda, historically we've done between like 0 and like a little higher than 0 of. For new hires, to the point where we just sort of don't hire people who don't already have trading experience, or I should say, like, I'm saying we still, yeah. So like it's a really valuable experience to be at one of those firms, especially like when you're just starting out.
Okay, well, you brought it up, so let's talk about it. You have stepped down as co-CEO of Alameda. What's up? What are you up to now? What's the motivation?
Yeah, I mean, like I wrote a thread on Twitter about this. It was pretty like I was fairly straightforward in the thread. The things I said there were basically just right in terms of my motivation. Like Alameda is like a super intense place that I really, really enjoy being at. And the problems they're working on are super interesting. I really love all the people there. But it's like intense enough that it was intense enough for long enough for me that I essentially just got like classically burnt out. And that happened. On some level that happened like years ago, and I've sort of been like treading water ever since in terms of tending to mental health or whatever. I just felt like the burnout and like continuing to be in such an intense environment wasn't really working for me anymore, and I need to prioritize other things in life.
Yep. Such as happiness, as you named the thread, right?
I thought that was self-important enough to go for.
For context for the listeners, like when I first met Trabucco, he was doing 30, 40 days in a row of work with no days off in between. So I can see where this was stacking up. But before
my record was 136.
What?
If we're keeping, well, actually I was keeping track, but if we're noting that.
Wait, 136 consecutive days?
Yeah. Well, it was going to be a little lower than that, but then the first day I tried to take off in a long time was March 12th, 2020, and then had to go into work.
Oh my goodness. Yeah. Okay. That's a lot more extreme than even I realized. But when you were first starting at Alameda, at that time, it was all about were you there when they were doing the Japan ARB?
No, I was not there for I wasn't there for the thing Sam talks about as the Japan ARB. I mean, that was a Japan ARB, but there exists other Japan ARBs as well. But the really big one for 10% or whatever, I was not there for. That was in early 2018. I was not there for like a year later than that.
And I know that's like where Alameda sort of got a lot of its initial capital that it used to trade things afterwards. And when you joined at that time, like what was the focus, and was it something completely different to what you had been doing before?
Yeah, it was totally different. The focus was in large part. This is in late 2018. The focus in large part was executing like kind of similar trades, in an automated way. So like the Japan arb was like, you didn't have to automate it really. You could just like, buy 10% cheaper and then send it over and like sell 10% higher. And that didn't really require like a complex setup. When that goes away, the kinds of trades you're doing are like arbs for like, 50 bips or percent or something. And as well as like taking advantage of future spreads changing. So like back in 2018, you'd often see things like the EOS quarterlies or something are trading at like a 3% discount. And then within a day, they're trading at like a 4% premium. And these things were just like moving around like crazy. And so taking advantage of trades like that, as well as, just like sort of generically good, like, oh, like we think, like we have idiosyncratic reasons for thinking coin X is cheap right now. We're going to buy a bunch of coin X. That's something we've always done, but it was still important back then. So that's the kind of trades we were trying to do back then. On a person level, we were like really desperate for people. We had a very small team. And the team would end up getting like sort of de facto smaller because soon after I joined, Sam started was focusing full time on FTX, like within a month or two of me joining, as well as like a bunch of other people who used to work with Alameda before FTX happened. And so like we were just really hurting for people while still trying to maintain a really rigorous place. In particular, it actually got more rigorous around this time when we started taking on more market making responsibilities for various reasons. Before that, striving for 24/7 uptime was a thing, mostly because the markets didn't close. There were always good trades to do, and any hour we're not operating is an hour we're not making money. When you have market making obligations, you have contracts and like agreements and whatnot that say I will have 24/7 uptime. And so before that, we could afford like a few hours here and there where no one was around, but we could not do that anymore after that. And we were working with a team of like a few devs and like 3 or 4 traders, and it was like quite an intense time, which sort of like leads into why I ended up getting burnt out. But
and you spoke here of sort of like the premium and then the discount. Could you walk me through what one of those funding arbs looks like?
Sure. Some of them are actually a lot more basic than even funding. It just used to happen a lot that there'd be like some huge position in some future. It doesn't really matter what it is, but like let's say EOS quarterlies for as an example, and like someone would put on a huge position, and then like EOS would go down a little bit, and then they'd get liquidated by quite a lot. Market making was very bad back then. A lot of the exchanges and a lot of the products just didn't have market makers. And so when something like that happened, there'd be like a liquidity crisis or something. So like it would obviously hurt EOS a lot, like every product, but in particular, it would hurt that EOS quarterlies contract. And like it might if it was trading at a premium before because someone bought up a ton of it and then EOS went down a little and they got liquidated. Now the EOS quarterlies are trading at like a 3% discount instead. And like I'm saying 3, sometimes it was 20. Like sometimes it was like actually just like wildly extreme. And if you have capital and like a setup to take advantage of this, you could like just be like taking advantage of these premium changes like just nonstop. Now this kind of thing is like, this doesn't really happen on anywhere near that scale, just because people, there are a lot more sophisticated firms out there with automated setups that would let this happen. Like Alameda would never, like if Alameda sees a premium change by like 1%, like we would have like started buying it 50 bips earlier than that. Just because it's like historically you can see that lately that's like the correct thing to do. But back then there were no, like people weren't sophisticated. There were like the firms that understood this didn't have setups or didn't have capital everywhere. And yeah, so it was just kind of it was the Wild West or whatever.
And what were the exchanges like back then? Like, did they have pretty good API connectivity or was it pretty poor?
It was a lot worse than it is now. This was never exactly the thing I was focusing on was implementing like actually touching the APIs.
Yep.
But my understanding from the devs and like the kinds of things that were possible back then is that there was like, I mean, I certainly know there was a ton of downtime. It was very common during large market moves that like you'd be lucky to be able to send an order. And so like often things would, this was also a contributor to why moves were so inefficient, and like, why like Bitcoin could be trading like percents apart for a few seconds on different platforms. It's because, like when the market moves a lot, sometimes an exchange goes down for 30 seconds or like an hour or something. Yeah, so that kind of thing happened a lot. Thankfully, much rarer now.
And at that time, were you already sort of in the position that you came into later, which was to make more discretionary trades at time based off information that you had, or was that happening later?
Yeah, that's always been something I've been good at and sort of tended naturally toward. Like back in the earlier days, it was a lot more important to generalize at Alameda. Our team was just so small and we had like so many things to do that everyone kind of had to be able to do them. Mm-hmm. And so, yeah, I was focusing more on other stuff that I would later be able to focus less on, which, like some of the automated side, which, it doesn't tend to be the kind of thing I enjoy focusing on or I'm particularly good at. Someone had to be doing it for the like 10 hours a day or whatever that I was the only one in the office. So,
yep. And that's like setting up models and stuff of that nature? Or?
Yeah, I mean, the important part is like being able to interact with the models. It's not like not everyone has to be writing them from scratch. In particular, like our models aren't even that complicated, so we don't like tend to write them from scratch that often. But being able to interact with like every parameter that feeds into our systems is important. That it's important that someone be able to do that all the time, and you have to understand everything very well.
Can you give an example of what an interaction looks like?
Our like Ethereum model has like some Bitcoin beta in it, meaning that like we think that if Bitcoin moves X and if we're using a beta of B, then that means that Ethereum will move by X times B. So betas will tend to be like smallish numbers, like around 1. And yeah, so like all of our models for like various coins have betas to each other, especially to Bitcoin. Like there, like maybe something like some big thing happened. Like maybe there's like news in XRP, like the SEC stuff from like winter of 2020 or whatever that was. Yep. That might like immediately tell me, oh, like I expect the Bitcoin beta to change substantially over the next few hours. And being able to interact with our models in a fast way to like to tell them about that can be a pretty big determiner of profit.
Mm-hmm. So you have like a 0.5 beta to Bitcoin with XRP, and you see this news, and it's going to move way more than that. You shift that quickly in the model.
Yeah, exactly. And there are ways to automate some of this. And our models keep getting better and better, or have kept getting better and better at like understand, like being able to having like quick ways of interacting with them, and B, like sort of understanding these things on their own to some extent. Back then, that certainly was not true.
And back then, very end of 2018, beginning of 2019, I know beginning of 2019 to mid 2019, there was a little rally for the first time in a long time. What were some of the more exciting moments or kind of craziest things that you think happened in that period for you?
I feel like it's easier to categorize the specific kinds of events later on. I guess one thing is the BCH fork. That was an early one. That was fairly interesting. That was I had only recently joined Alameda when the BCH fork happened. And that was I already knew crypto was kind of nuts. That was an update about how nuts crypto was exactly, or like how nuts crypto trading was specifically. For context, that was when that was when in the lead up to the BCH fork, the OKX was like the only exchange that had popular dated futures back then, at least like on weeklies. I think Huobi hadn't listed them yet. And the OKX had some contract expiring after the fork, and it started trading and they also had a limit for the discount that futures were allowed to trade to spot. And like while BSV was still being priced at less than that limit as a fraction of BCH, I think it was 20% was the limit. Mm-hmm. like if BSV is being priced at like 7% of BCH, that's fine. The futures can just trade at 93%, and that's fine. Because critically, the futures are going to expire to not BCH plus BSV, but just BCH. But eventually BSV started getting priced in by people who were thinking about this, as well as the markets, at higher than 20% of BCH, meaning that the futures, which could only go down to 80%, were now just way too rich, because maybe they're supposed to be 60%, and it's impossible for people to sell them there. And a lot of unsophisticated traders did not realize what was going on here, and so people who were in the know about what the futures should be trading at were able to sell quite a bit at 80%, which is oh, great trade. But then OKX expired the futures early, such that they should have been worth 100% instead of 60%. That was quite an interesting few hours around when they did that. Also, the fork itself, even outside of the futures nonsense, was pretty interesting. The BSV BCH premium was swinging around so wildly, even in the immediate aftermath of the fork. We had a guy whose only job during this was stand there screaming about how long the blocks took to mine, and because the prices were just actually just moving percents based on how long these blocks took to mine in the immediate aftermath, which is not something that we see anymore.
Because it was unclear if the miners would support which of the two chains, right?
Yeah, and so the block time was an early indicator of what was going on with that.
Yeah, I remember it took a while for that first BCH block to be mined, or there was a big pause there, and everyone was thinking, "Oh shit." I mean, I'm gonna fast forward since we're talking about forks. We have the merge coming up now. I know you probably haven't been thinking about this too much as you've sort of stepped down from the trading side of things, but what's your sense on what happens with sort of the ETH POS versus ETH POW? Do you think POW just gets valued at zero and then whatnot, or?
I would say that if I were guessing based purely on fundamentals of what the products are, that's what quote unquote ought to happen. But crypto markets have proven time and again that that's not a thing you can always do. Is price things strictly based on fundamentals like that. So I guess I doubt it based on priors there. But yeah, I'm not going to pretend to have thought a ton about this.
Yep, so. Totally. But let's say from a first principles or from a trading mindset, if you had to analyze this problem without going into specifics about this one, what are some of the things that you consider to then make your decisions?
Mostly, on some level, what I think about the products doesn't even really matter. The thing that matters is what I think other people think about the products, if I'm just trying to price them. And yeah, that's sort of for the same reason I just mentioned. If you assume that literally every person is making informed decisions about pricing based on informed understanding of technology and fundamentals and whatnot, then my understanding of the fundamentals and the technology start to matter. But really, all that matters is my understanding of what other people will price this at, if I'm just trying to price it correctly myself. And yeah, so the more important thing is understanding sentiment around these things, looking at historic examples of things that have been similar historically, and how people thought about them then, and also the mapping of that sentiment and how people are thinking to price moves can also inform my current mapping of what it looks like sentiment is to price moves. And yeah, so that's the kind of thing I try to think about rather than actually understand the technology. We have other people who are better at that anyway. I'm rather internally, people would always make fun of me for not understanding technology. So
yeah, but you were so and to sort of acquire the sense of sentiment, was it mostly Twitter, or is it just a combination of different forms of content being produced and you assessing based off that, or was it price action? Where would you kind of scrape that?
Yeah, Twitter. And I don't really mean it's not scraping exactly. I have a smallish set of people whose opinions about this kind of thing I tend to trust, and they'll talk fairly people on Twitter. People on Twitter talk extremely openly about things in a way where they're sort of just leaking information, and once you obviously that's true for like people who don't have information as well. So it's important to like understand who is worth listening to. There's a small set of people who are like really worth listening to on each topic. And yeah, knowing that set of people is like pretty good.
Got it. That makes a lot of sense. So potentially like somebody could actually trade crypto somewhat successfully if they're able to create categories of good people for different subjects and then like trade those subjects.
Yeah, plausibly. And like, I mean, things change over time. And it's like, and sometimes the topic that a person is like really good at giving information about is like a specific thing that only happened once. And yeah, trying to identify those people for different kinds of things is quite good.
Got it. And then you kind of have like some internal checklist of like, if they said this, that actually happened, then they said this and it actually happened again, they're probably competent. Makes sense. Okay, so going back in time, we were talking about like 2019. I don't think much happened in 2019. I'm sure you guys probably traded like Chainlink when it was pumping and nothing else pumped, which might have been like somewhat interesting.
Yeah, I mean, let me see. Yeah, I mean, like Bitcoin was I can't really think of a ton of like discrete events that happened during 2019. The price moves, or like for months at a time, prices just didn't move during 2019, if I remember correctly. Yeah. But during other months, prices were moving quite a bit, especially in percentage terms. Like Bitcoin got really low during 2019, right? If I remember correctly.
3K.
This gave us a good chance to improve our systems, if I remember correctly. Because like, there were like months where very little happened. And so we were generally able to spend time focusing on our models and our systems to some extent. On the other hand, it also made it even harder to hire people than it already was. Like it became pretty unappealing to join a crypto firm when like, in 2018, when it was like hitting, or 2017, when it was hitting 20K for the first time, it was a decent amount more appealing.
Yeah, that's what I was going to ask too, was my next question. Is there was a pretty long bear market there. You had obviously traded traditional markets before. Where was the conviction to stay during that time? Like what made you think, hey, this might turn around at some point?
Yeah, I mean, to be clear, like even like crypto, like when it's really slow and not much is happening, is still like a more lucrative trading environment than anything else. If you're like mostly executing ARBs and whatnot. So the conviction was largely monetary still, even during the bear market, because we didn't really have positions back then, or like not large positions for very long. And like we still like that's still not something that Alameda will like often do. But yeah, like it wasn't like we were like hemorrhaging money because of our long positions during this period. We really didn't have a long exposure. We were just doing ARBs. I mean, there's some extent to which like a business whose thing is trading crypto has some like it's synthetic long exposure to the market, like both because of hiring and also because there's correlation between volume and price, and more volume is good for us because it just more opportunity to do ARBs. But for the most part, like we were doing a little worse because again lowered volume, but it wasn't really a function of price exactly.
Mm-hmm. Got it. And then if I remember correctly, late 2019, there was that run up from like 3K. It slowly went up to 12, 13K. And then it was kind of not really doing much. And then we went to 2020. And then March 2020 happened. And that's kind of like a huge shift on the global scale. Love to hear what that was for you from a trader's perspective and how that went down.
Yeah, I mean, it was scary to some extent because the world was falling apart, like markets were falling apart. This is a period like during that couple days, we like it was the best trading I've ever seen for the most part, but there were like still a lot of scary moments during it because we mentioned before that like exchanges used to be a lot worse, and the tech used to be a lot worse. And like big moves might cause like outages on the exchanges. That was certainly happening on March 12th. And yeah, so like often so it was pretty possible to like for our systems that we usually get very excited by, Bitcoin's trading 10% lower in this product than on the other product. We should like buy a ton of it. If you do that and then Bitcoin is like falls another 30%, that's pretty bad, especially if you can't get out of it. And especially if, like, even if you're like generally pretty safe with leverage, the moves were just so big that you could still get liquidated on them. And, that we were not immune to that either during this period. But yeah, for the most part, the trading was just incredible. Like, again, for a firm who's mostly doing short-term stuff. And it also gave us some opportunity to do long-term stuff just because, like the liquidations brought prices so low that it was like they didn't have that much more room to go down.
Yeah, absolutely. I mean, it was like kind of like a weighted coin flip at that point. And if I understand correctly, probably the biggest issue of that time was it was really hard to collateralize accounts too, because everything was just congested as fuck.
Yeah, that's also true. Yeah, so like Bitcoin was taking like 4 hours to like have transactions register. And yeah, so that was like a core reason that, for instance, BitMEX is like Bitcoin futures got so low during that day. Like there were a ton of people who would have loved to buy Bitcoin when it was like like $1,000 lower than everywhere else, and like on its death march to zero or whatever people think was going to happen, and like us included. But we just could not get the capital there fast enough. You need they only let you collateralize with Bitcoin on BitMEX, or like that was true back then. I don't know if it's still true.
Yeah.
And like the Bitcoin network being so clogged meant that like literally no one could buy if they wanted to.
Yeah, I know a couple of people who had a little bit of funds left, and they were able to like 100x and kind of be safe from liquidation because the price was so dislocated from the index.
Yeah.
Yeah, crazy times. And then from there, it was kind of this march upward that we saw for a really long time. I mean, it was
awesome.
It was really incredible. And also there was a huge phenomena there that never had existed before, which was yield farming. So I'd love to hear kind of, this crazy day happened. Everything was hard hit. I'm sure there weren't even that many of you guys when this was happening, right?
It had gotten a little better if I recall correctly. Hiring had gotten a little bit better, and our trading team had some more people on it, and we had like maybe 3 devs instead of just Nate.
Mm-hmm.
It was still the team was still fairly small, and like yield farming sort of just popped up overnight. That's not quite literally true, but it got very popular very, very quickly. Alameda is exists as a quant trading firm in crypto because that's like where the money is. But when yield farming popped up, now that was where the money was, and it was kind of easy as a transition, just because it's still crypto. We still have like all these coins. We still have good setups for borrowing cryptocurrency and whatnot, and we still have a bunch of it. And so it was certainly like a big task to get set up well on the yield farming platforms, especially automating them. That was something that took a decent amount of time. But on some level, it was just like another solution to, we have capital, we have some resources like people and time, and we want to make the most money with those things. And yield farming was like another option, and often the right answer.
Mm-hmm. And so for a moment there, or actually before talking about yield farming, after this March 12th crash happened, did your guys' opinion readjust strongly on crypto, or what was there a big shift after that, I guess, from your end?
I mean, I wouldn't say fundamentally because it's important to remember that the stock market had the same move, less extreme, of course, but it was the same kind of move anyway. And it to some extent, before that big crash, people were you saw discourse a while ago, maybe Bitcoin's a flight to safety asset. Maybe the next time the stock market goes to shit, Bitcoin is going to be just fine. And that was not true. And to some extent, that's an important update. It's also an important update that Bitcoin is now seen as being a risk asset correlated with the stock market. It was sort of an early sign that there was global interest in this thing, especially by established firms, because that's the only thing that can really lead to a significant stock market beta.
Mm-hmm.
But I don't know, it didn't make us think that it was like, not an asset class that was here to stay. When the stock market started recovering, so did Bitcoin, and so did crypto. And so that was like just kind of good. So I don't know, like if anything, it was like good from the perspective that it seems like you're getting at, but I don't know.
Yeah, no, that makes a lot of sense. Actually, something that I remember really happened there is what you just said, is everyone realized the beta to TradFi, like our traditional markets. And
Yeah,
did that
Bloomberg sucked.
Yeah, that's what I was gonna ask. That's what I was gonna ask. Like, did all of a sudden you guys have to start thinking a lot more about traditional markets than you had to for the last 2 years or year and a half or whatever?
Yeah, it was it's definitely like net good or whatever that this happened. But I can't say I was thrilled to have a Bloomberg terminal again.
And you just said this, but essentially what this meant is that big funds that traded stocks and other traditional assets were also trading crypto, and that's why, like, if they divested their equities, they would divest their crypto, and that would bring the price down, or vice versa.
Presumably. Or presumably that was happening to some extent. That doesn't exactly have to be it, though. It can also just be that, like, or actually, it just kind of have to be that. It does have to kind of be that to some extent. So yeah, basically yes.
And then I guess like another thing that we saw after this, which seemed to be a pretty big changing point for me, curious if it was for you guys, was Paul Tudor Jones coming out and sort of taking out the reputational risk of having Bitcoin by being super public about being in Bitcoin. Was that sort of a big thing for how you guys updated your model on Bitcoin?
Yeah, it was another point in the direction of now traditional players matter more. Now crypto has some institutional adoption. So yeah, it was definitely a big point in that direction, but it was just another point in that direction for us.
And was it a worry for Alameda that now potentially you would start seeing some of the largest trading firms entering the space that you guys were in?
Yeah, that's something we talked about a lot. We felt like we had enough we weren't that worried about it. Those firms tend to move fairly slowly. Like just from a risk perspective, as well as like a tech perspective, those firms can often move kind of slowly. And we felt like we had a bit of quite a good head start in terms of understanding some of the idiosyncrasies crypto has. But it was definitely a concern. We thought about what are some advantages we specifically can have. Didn't really come up with that. I mean, I mentioned that our models aren't like the most complicated things in the world. But we have a lot of we always had a lot of information about the crypto markets. We had like really good relationships. That was something that was going to be hard to replicate, and I think remains so.
Yeah, that's what I think I was going to ask too. Is since you guys were doing a lot of market making as well, you guys were sort of in with the crypto native projects in a way that these firms wouldn't be able to, right?
To some extent, yeah.
To just have like the relationships and stuff. And then yeah, yield farming. Yield farming was crazy. I know it was really good for Alameda, but like it's not free for it to be that good. You guys made a risk assessment and realized that you were willing to take the risk. How did you guys think of that?
Yeah. I mean, it's our framework for that kind of thing is kind of simple, or like has always been kind of simple, in that, there's as like one example, maybe you're like posting some collateral on some platform, generating like yield X on it. But there's like some probability that it all gets stolen in some hack or something. If you're a firm who doesn't like have risk intolerance, what you can kind of just do is multiply the yield by a 1 minus P, if the probability was P. And that's your new yields because, in expected value terms, that's exactly what it is. And if you're never risking enough capital to be in trouble, if the capital goes missing, then that's just kind of fine. Like you don't have to care about risk on that level, because you're going to be making enough of those bets that you will eventually achieve the actual average. And that's certainly what Alameda has always been doing, is making a ton of bets like that. So that we always achieved the average, instead of sometimes being totally screwed because one of our 3 bets lost all of its money, and now we're now we don't have any money anymore.
Yep. Makes a lot of sense. Okay, so it's like very willing to take big risks as long as it is segmented into smaller chunks and it's not the whole pie.
Yeah, totally. Making these things independent is also always good.
Got it. Got it. And in that sense, independent, you mean like two things yield farming is not independent, essentially, right? Like,
yeah, like maybe like there's like a bunch of pools on one platform, but like if the money goes missing on one of them, it's going to go missing on all of them. You have to like, those are like now dependent risks.
got it. Yeah, makes a lot of sense. And one thing I'm curious about is I know for Alameda, especially early on, even like right around the time DeFi was starting, everyone was like super agnostic to crypto. It was an asset to be traded. It was an asset, that you could have an edge on and whatnot. Do you think that shifted at all as we saw more things start appearing in the crypto world, or is that still kind of like the prevailing thought process you had throughout the last, 2 years?
Yeah. So I mean, I guess there's two axes along which that kind of thing can be thought about. So there's price, and then there's optimism for like the technology being used or taking off or whatever. Price wise, there have been periods where Alameda as a whole was like pretty confident prices were going up, and also the opposite. Mostly the former, especially during the time you're talking about. But we're the prices have moved so much that there have been periods of both. I do think that over time, people have gotten more buy-in. Like there's been more internal buy-in about crypto will play a role in the future to some extent, especially as more sophisticated blockchains have popped up, and there have been more exciting projects that have actually happened. I sort of never really before some of the faster blockchains happened. I wasn't personally very excited about the prospect of crypto being an important part of the landscape. I just couldn't some of the older blockchains just literally could not support it. But in recent years, there have been a lot of exciting developments there, and I think that I don't want to speak for other people, but for me, I've certainly had more personal buy-in.
Mm-hmm. And what something I'm curious about is, March 2020 happened. It was kind of like a once in a lifetime black swan. These things are maybe not once in a lifetime, but like very, very, very rare event. And it was like pretty unclear what was going to happen with markets, both traditional markets and crypto markets after that. Where did Alameda get the conviction to sort of like be a part of crypto and think it was going to be an asset class that was going to keep growing? And if I understood what you just said correctly, like you guys had some directional exposure after this happened.
Mm-hmm. I mean, mostly, we constructed internal, we constructed distributions of what the prices are going to be in a few weeks or a few months or whatever. Decided that there's no real reason that this the real thing was that we decided that on average the stock market will recover, and if the stock market recovers, Bitcoin will recover way more than the stock market did. Because it went down way more when the stock market crashed. And so it just sort of seemed like it was pretty likely that Bitcoin was now going to have a way higher than 1 beta. And yeah, so it kind of just made sense to make that bet.
And if you sort of arrive at that decision and you realize, okay, we're going to take some directional exposure here, do you scale into it, or is it it's as low as we think it's going to get, let's go hard? How does that side of the decision process work?
This is actually something we used to screw up a lot. Pretty often we would have something someone has some opinion and they want to put some position on, and they don't specifically maybe it's a decision on it's a bet on a week time scale or something. I think that within the next week coin X is going to go up, so I'm going to buy the coin, and we would often be oh, well, it's a week-long bet. We don't have to hurry. We can even just TWAP into this over 2 days. But in general, and let's say that we think that the price is going to go up at some point during that week and we don't know when. So that means if you wait a week or if you wait 2 days to put the position on average, you'll be missing out on a full day of exposure to the price move that you think is going to happen. So really it's pretty unlikely that you're actually saving that much in execution costs by going more slowly. And so we sort of tended to do things a little faster once we realized we kept doing this over and over again, and missing out on EV because of it. And so, I mean, I don't exactly remember the details of the specific thing you're talking about, but and it's even possible this is one of the things that made us question our execution speed. Actually, that sounds vaguely familiar. But it's something that I would advocate doing faster than most people tend to.
Got it. And if somebody had conviction that something was going to happen, how does that get socialized in Alameda? Like, how is someone able to sort of advocate for a directional play?
Like, I mean, there are a lot of people who say stuff like this, but Alameda is certainly a best idea wins kind of place. And we've always tried to encourage people to be like super open when they have an idea, even if they think it's like a little weird, or like even if it's someone who's like, new, or like recently, like who hasn't had ideas like that in the past. Just because, like, there's pretty low downside to that. All you're doing is wasting like 15 seconds of someone's time for reading your post. But pretty often we've had really good ideas come from stuff like that. So we try pretty hard to encourage people.
Got it. That's really cool. So you say Alameda like encourages creativity rather than like focusing purely on systems.
Yeah, totally.
That's really cool. So the market's starting to recover. If I recall correctly, hiring starts. You guys are able to hire more after all of this starts happening to some degree.
Yeah.
You guys were based in Hong Kong. How did that work? Like, how would you get people to say, hey, yeah, we're going to move to Hong Kong, and kind of like to a country where you have to quarantine to get in and whatnot?
Sure. So we hired some people who already were in Hong Kong. That was helpful. But we also were hiring people from outside of Hong Kong. It did get harder after after the quarantine started getting mandated. But we did find some people who were willing to endure that anyway. The challenging part of the quarantines in Hong Kong was really the inability to travel. For instance, like a lot of us were just in Hong Kong for like 2 years in a row, even though we're not from there, which involved like, not being able to see anyone from our normal lives. It was a pretty good place to be, all things considered. Like restaurants didn't close, for instance. So yeah, I'm not complaining about having been in Hong Kong. But yeah, so it made it, but it definitely like hurt us a bit. And yeah, the hiring was part of why. But yeah, some people were willing to do it, so that was nice.
Do you think it actually, so I think from FTX's perspective, I think that helped FTX's development because no one had anything to do except like work all day. Especially like Sam and Ashad were pushing so hard, so everyone did the same. Was it the same for Alameda?
Yes, that was a consequence of all of this. I definitely probably Alameda's ended up in a much better place because of the quarantines and people not having anything else to do. But I think various people's mental state and happiness did not end up in a better place because of it.
Yeah, fair enough. Okay, let's go. So we're going into 2020, this yield farming. There's probably a ton of stories there, but let's go into 2021. I want to talk a little about Doge. I know Doge was you were an active trader of Doge. I would love to hear that story and kind of like where your conviction came from so early.
Yeah. So I mean, the main thing was that Elon decided that Doge was his like favorite coin in the world or something. We later find out that apparently that was because his son really liked it, and he would like trade it with his son or something like that. I don't really remember, but he said that like months after all this happened. But yeah, so Elon decided that Doge is like hilarious and like a great thing to be tweeting about all the time, so like it. He was very much having price impact with his tweets, the thing that I've said in the past is that once he's done this like twice, the probability that he's going to do it like 10 more times has like this sort of skyrockets. So it just becomes really likely that he's going to keep doing this. It's possible that he doesn't, in which case it's like sort of likely that the price of Doge just kind of slowly trickles down because he's had some positive impact. But if he does keep tweeting about it, it just sort of seemed like it was going to 50x or something like that. And it's pretty hard to construct a realistic probability distribution in like, I don't remember when this was, like maybe let's say January 2021. Like it's hard to construct a distribution that where like the outcomes you'll lead to like, losing 1x or making 30x. Like it's pretty unrealistic that buying that is not good. And Yeah, so that's, I guess, where the conviction comes from. It's not exactly conviction even. Like, it's not like I believed in the fundamentals of or anything at any point. But yeah, I certainly believed in the fundamentals of Elon sort of continuing on whatever trajectory he was on.
Yeah, I mean, it was totally true. It did pretty much 50x from like the second time he tweeted. And so you have this idea, right? And you're like, hey, Elon's tweeted twice. He's probably going to tweet a ton more times. This is probably going to go up a lot. Do you just like socialize this in Alameda and say, hey, I want to get massively long because this is happening?
Yeah, it's pretty simple. It's kind of all that happened.
And was it pretty liquid at that time?
Yeah, there were days on the big exchanges where Doge traded more than Bitcoin around this time.
I remember. Yep, definitely remember that. And then I guess my other question is that the harder part seems to be when to exit a position like this, because it's just mooned so much and it like the whole world's talking about it. Elon's still tweeting about it. It feels like it will never stop. How do you know when is the right time to take profit and like not lose out on all the potential expected value?
Yeah, it's sort of all intuition. It was quite unprecedented, and so it's really just kind of guessing, like, what is going to be the best time for this. Like the SNL episode sort of seemed like a really good candidate to me beforehand. It was like way too hyped. Like that was just sort of obvious from how people were talking about it. And people had like really unrealistic expectations for what was going to happen during that SNL episode. They were sort of acting like Elon was writing the episode himself, which is not how SNL works. If you look into it at all, the hosts have very little control over what happens during the episodes. And like if you looked into this on the internet, like in the lead up, there were like cast members who like we're not going to the episode because in protest of him hosting.
Oh, I remember that.
So it was not likely that the writers of SNL were going to like pander to Elon's Doge agenda, and they in large part did not. So I think this ended up being like a good read, but it's really all intuition and sort of guessing how things are going to happen. It's not quantitative at all.
Yep, that makes a lot of sense. And so it goes back almost to this thing of like sentiment and seeing where that sentiment can top out and like kind of tie that to a real event and then sort of make your execution decisions based off that.
Yep.
And was part of it too that like leading up to this SNL scale, like liquidity was probably off the charts because everyone was all they were thinking about was Doge.
Yes. Yeah, and if you look at the charts from back then, the SNL episode was essentially the top. Like it crashed during the episode and then like didn't ever recover.
Mm-hmm. Yep. Yeah, I remember that. What happened after Doge? Did everything sort of get somewhat boring because yield farming was somewhat slowing down and ending, or what was the next sequence after that for you?
No, it wasn't boring. This is when like regulatory stuff starts happening, right? Like the U.S. government starts talking a decent amount about. Actually, that was a few months later. I can't remember like discrete events again during this period, but there was like the price moves were like still pretty extreme. Like this is.
Oh, you're right. Yeah, crypto was still just like purely going up for a while.
Yeah.
Into May, into end of May.
So, yeah. No, it was. So there weren't like I can't point to specific events right now, but like the price moves were very extreme. So it was quite a fun period.
Oh, so that's actually my next question. So in May we topped out super strongly. Like the markets came down really hard.
Yes.
How do you know those? Like, how do you figure out those times are coming? Like, is it just that the bubbles get too bubbly and it's like, hey, this is insane, this needs to turn around? Like for a trading firm or for you, how do you then determine like, okay, we need to take the opposite side of this?
Yeah, it's definitely not. I can't claim to have a great framework for predicting like Bitcoin's top or anything like that. That's not something we even did. It does become possible to like make idiosyncratic bets about market structure events, or at least that's something that Alameda has always been able to do. I've talked about this on Twitter a lot about like being able to note like, oh, like Bitcoin was going up forever, then it went down a little bit. It's like pretty likely that if it goes down like a little bit more, it's going to go down a lot because of liquidations. it just creates a pretty large asymmetry between up and down. So like, even if I think it might recover a little bit right now, or like, even if I think it might recover a bit right now, it's only going to recover a little, but if it goes down more, it's going to go down quite a bit. So that's the kind of bet we would be making back then, rather than like, like trying to make predictions based on fundamentals about Bitcoin, that Bitcoin's up, like the Bitcoin's going to go down now. That's not something that we ever did.
Got it. And then the other question following that is, it crashed so hard and it kind of seemed like it was the end of the world. For a moment there, it was like, Bitcoin went from 64K to like 27 or something. And kind of everyone thought, oh yeah, this is over. How can you sort of get a sense that maybe there will be another sort of second rally, and that this, like, it felt like the bear market was there all of a sudden, but it wasn't. We had this whole other run. I guess, like, how do you trade something like that?
So this was, again, like a period where market structure was pretty dominant in terms of what we were thinking about, because when like the crash was because largely of liquidations from the top, like I just said, and predicting when that was going to stop was largely about like predicting when the liquidations were going to stop, or at least like when they were going to stop being like a dominant force of what was going on. And so that's what we were really trying to do. And when that seemed like it was over, and when like a bunch of liquidations hadn't happened in a while, and it started recovering a little bit, that's when we decided that it was like pretty likely to continue recovering more, because the liquidations drove the prices down. I'm not going to be able to remember numbers right now, but the liquidations from that top drove it down into like the 35K range, if I recall correctly, which seemed at the time pretty unlikely to be what the market actually wanted to do, and rather it was like more forced by liquidations than anything. And so it was pretty likely to have a short-term recovery at that point, which is the kind of market structure-based analysis that I like doing anyway.
Yep. Yeah, that makes a lot of sense. And then, was there anything else sort of that you found interesting between that period and then when we hit the other top in like October of 2021?
Nothing extremely specific that I'm remembering right now. This was, it was pretty dominated by these market structure-based things, and like, just sort of being, being as good as possible on the days when there were big moves. Like the big moves at this point had gotten a lot rarer. Like comparing this to 2018, like the crypto market wide moves that would, in the double-digit percents, were like, there were like 3 of them in the second half, or in like the month we're talking about, and there were like 40 of them in the month in the month during 2018. So yeah, the big moves got less important, or like less common, but it became like really important to optimize for those days. And that has a few consequences. It means that like on a median day, one of the best trades to do might be like putting on some spread between perps and spot to generate funding or something like that. And like maybe that's like the best trade to do, or maybe the best trade to do is like putting capital in some yield farm. But like maybe it's locked or something, and maybe it would take time to unwind it. Your bar has to go up for things like that in periods that are dominated by a few, like where P&L is dominated by a few days, because if your capital is not accessible on those days, that's like a disaster. And so you really have to be optimizing for those kinds of days. And this is the kind of thing that becomes a lot more important in a period like the one we're talking about, and sort of like the crypto market is currently in to some extent. When the really big trades get rarer, you really have to think about optimizing for them all the time. And yeah, that's a mindset shift that happened around this time.
Yep. Yeah, that makes a lot of sense. And then I guess we can fast forward. It went up to 69K in like October, November of 2021. Funny enough, like Elon posted a chart of it at 69K, and that was like the Pico top. And then it's been down only. And then there was a bunch of people who went insolvent for various like mismanagement of risk. How does a firm such as Alameda manage a market that enters these wild conditions?
Sure. So yeah, like maintaining the ethos that I mentioned before, where like, we're literally never putting enough money at risk at any given time where we would actually be in any real trouble if things went south. And like, that's always been Alameda's mindset, and that helped a lot during this period. Things like, profit certainly gets worse in a period like that, where, volumes go down, although honestly not down as much as I was predicting. Volumes kind of kept up when during this crash. Yield farming gets worse, but the opportunities for a firm that has really good tech, really good people, like Alameda, is still pretty good.
Mm-hmm.
So yeah, making sure that we literally can never risk enough that we cease to exist, makes it so that like we get to keep existing, and existing is like good, especially because we were always still profitable during this period. So
got it. Yeah, so like base rule is just survival. Don't put yourself in a situation where you can't survive.
Yeah, that's always the most important. Assuming that you're like profitable when you survive.
Right, fair. And yeah, so now, the markets are kind of hanging out at this low. It's been at 20K for a while. Also, so traditional markets have gone down quite a bit. As you said, volume actually hasn't gone down as much as I probably expected it to with the price action. There's still sort of like a lot of things happening around like the Voyager claims and the Celsius claims and all these different things. But my sense is like the biggest reason that this price point is happening in crypto and traditional markets is kind of like people being very scared of the macro environment. It's like the energy stuff that's happening in Europe and different things of that nature. What's your sense of like moving forward? Is it just going to be based on what's happening on the general macro aspect of the world, or do you think crypto can find legs on its own?
Yeah, I mean, the more time that passes where, where Bitcoin and crypto generally maintain a beta to the stock market, like it's kind of the more likely that keeps up, like because people, like more people will become aware of it. Like more firms, like traditional firms, will be trading it because like assuming it has that beta, and that's sort of self-perpetuating. Like if maybe right now, like let's say 20% of firms are trading Bitcoin, like as more, if assuming more and more do, then when they're looking into how to trade it, they're going to be like, oh, it has a beta to the S&P 500. I should be like, when the S&P 500 moves, I have to make sure my Bitcoin models move in the same direction. And then now like it's an even stronger effect that like can deviate even less often. So yeah, this is sort of self-perpetuating, especially if it gains widespread like institutional buy-in, and like the US regulatory environment remains friendly or like gets friendlier, then this sort of has to keep existing to some extent. I don't really see a way out unless the U.S. regulatory environment shifts a lot, which is certainly possible, and I don't want to rule that out.
A couple more questions for you. One being, if you had to give advice to somebody coming into the crypto space, and they want to conceptualize it or know how to interact with it, and it could be from a speculative nature or just like a working nature, like what are some things you could leave with them?
Yeah, like you have to have, or like something that I screwed up early on was not, or like having thinking that things were going to conform too strongly to a more traditional paradigm. Like I would often see this actually describes my very first interaction with crypto, where like I was not in crypto trading at all, but I noticed that I saw that like Bitfinex and GDAX, I think GDAX at the time, now Coinbase, but I noticed that the prices on those two spot exchanges, like the two biggest that had where US customers could access them, was like a percent or two apart. And I didn't check it immediately because I was like, oh, that's a data problem. There's like no chance, but it turned out to be correct, executable, and I sort of had to pursue that once I noticed that was like legitimately happening. And that kind of thing like used to happen to me all the time, where I would like see something that like looked like using priors that are based entirely on trading in traditional markets, and like this sort of more traditional understanding of how finance works, like couldn't be right, and I just sort of didn't believe them. And yeah, lowering my bar for like how like or yeah, like changing my priors about that kind of thing was pretty important early on, and remains pretty important. Like, you know, like things are a little less crazy, like I've said, but they're still like kind of crazy if you're just coming from a traditional world. So being willing to like believe that things might be as they seem, and you know, might actually be crazy, because crypto kind of is crazy.
My last question for you is, what's next, Trabi? I mean, you talked about it a little bit in the thread, but do you have some things you definitely want to pursue, or is it just kind of a live by day thing?
Yeah, nothing specific. I don't have any like, I certainly don't have any like productive things going on right now, which is I'm not currently planning on starting working anywhere else. Like if I wanted to be working, especially working on crypto trading right now, it would just be at Alameda. I really do love Alameda quite a bit, and you know, miss the people, miss the place and whatnot. So I'm not doing anything like that. In terms of like, you know, specific plans, like lately I've just been traveling, visiting people who I haven't seen in a while. You know, really slowed things down. I've been playing a lot of Storybook Brawl, great game. I recommend it. I'm currently in the middle of a puzzle competition, which I haven't been able to focus on in a while. Writing more crosswords. Yeah, just doing a bunch of the things that I have not had time to do because of work over the past 4 years. It's been nice. That's currently what I'm planning on doing short term. I imagine I'll get bored at some point and want to have a more you know, structured thing to do, but hasn't happened yet.
Maybe you can pump that book out at some point.
Yeah. Oh yeah, I do kind of want to write a book. I'm going out on my boat tomorrow. That's exciting.
Nice.
Yeah, the boat's great. It's called Soak My Deck, for anyone interested.
It's a good
Proud
name.
of that one.
Well, thank you so much for coming on the podcast, and you know, it's been good, sort of to some degree working together, I guess, but also just like spending time, and hopefully we can continue to do so outside of any work environment.
Aw, adorable.
Thanks for coming on, Trabucco.
Yeah, of course.